Investing lessons from Buffett. Before we begin the video, let me remind you the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.
I'm not recommending that people buy stocks today or tomorrow or next week or next month, but you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them, and you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it. There have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up? You've got to be in the right psychological position. And frankly, some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time.
John Hussman shares this tweet with some wise advice for investors. What investors view as wealth is actually just the current price of their future wealth, except for individual investors who sell into the extreme valuations that are periodically offered by Mr. Market. Those prices are just blotches of ink on paper and flashing pixels on a screen. For long-term investors, the wealth is in the cash flows, and those cash flows are in the denominator. I talk a lot about that on this channel, the different investments that I make. And I talk about the future cash flows. John says it's not wealth that's being wiped out, it's market capitalization. The wealth is in the cash flows, the wealth is the denominator. The market cap was speculation encouraged by a reckless Fed. That was the policy error. So there's some real wise advice there from Buffett, and especially for us precious metals investors who have seen quite a large drawdown on our positions. And, each one of us needs to have a look at ourselves in the mirror as investors and take into account what Buffett just said. And, as a value investor, I define value investing as investing in profitable companies when its shares sell at significant discount to its actual intrinsic value. And I've been telling people that for a while, and then people say, well, what is intrinsic value? And for me, that's the discounted value of the cash that can be taken out of a business during its remaining life. And so that's what I want to get into in this video, is talk about my portfolio, how I allocate capital, and give you guys a bit of a framework on how I invest and my philosophy and strategies. And if you like it, please hit that like button. We really do appreciate that. And if you want videos like this, and perhaps maybe going into more detail on things like return on capital, return on equity, PEG ratios, and all that sort of stuff, then let me know in the comments below. So there's a lot of ways that you can build a portfolio. There's a Solomon portfolio, which I think it was Dr. Craig Israel from Brigham Young University did a back test of all these different portfolios and found that that this was the best performing portfolio since the early 70s. Large cap stocks, small cap stocks, international stocks, commodities and natural resources, real estate, and REITs, bonds and cash. So 7 different asset classes. So I think it averaged just under 12%. Now, you can do that. Then we've got the Dragon portfolio, which I've spoken about quite often. So that's 24% in equities, 18% in fixed income, 19% in gold, 18% commodity trend, and 21% long volatility. And I've actually done videos on this, so I won't go into it any further. And then another one is the magic formula. So Joel Greenblatt, the magic formula in his little book that still beats the market. This is where he focuses on return on capital and earnings yield. And in his book, You Can Be a Stock Market Genius, is where I learned about leap options, and that led me to learning about options in general. So for me, I look at all these different portfolio strategies. I look at Buffett, I look at Graham, and some of the more modern guys that invest in growth and momentum, like a Wes Gray. And I've kind of blended it to come up with my own strategy over the years through a lot of trial and error. All right, so my investing approach. So I break my portfolio into 4 parts. So first, I have part of my portfolio focusing on value stocks. Now, Buffett likes to use price to book and return on equity, where Greenblatt likes return on capital and earnings yield. But I like to go for the cigar butts in this space. And, I shared many times how I bought coal stocks at 1.8 times earnings. Coal was just beaten down and portrayed as, the evil stepchild, so to speak, and no one loved it. So it's basically out of love stocks that are just so dirt cheap that it's still got a few more puffs to go. And, well, as you guys know, most of my coal stocks are up, 5 times. I sold out of Peabody at over a 10 times return. One of my coal stocks, based on my buy price, I'm getting a 56% dividend yield. And, another stock going back, I think it was 2015 or 16, was Metcash that I bought. Metcash was in big trouble. I bought them at a really, really cheap earnings. And, well, they ended up turning the business around. So it ended up having more than 1 or 2 puffs in that cigar. And I'm now getting a 20% dividend yield on that one. And there's another one that I'm looking at the moment, which I won't discuss right now. But that's how I look at value. At the moment, I predominantly go into that cigar butt stage. Growth stocks, so you got your PEG, your earnings growth. So just looking at earnings here, and I look at growth, but because I've got that value in me, I don't pay any price. I don't pay, a 50 times, PE, because it's got, a good earnings yield on it. Yeah, so for me, I like the PEG, which is just the price to earnings divided by the annual earnings per share growth in a company. So it's what Buffett kind of, the Buffett likes to buy quality companies at a fair price rather than a fair company at great prices like he used to. So that's the difference between the cigar butts and, I guess, more that growth. Now, I'm not really in any growth at the moment. I've really trimmed all my growth positions or exited completely because of my belief where the market is heading. So then another part of my portfolio is my option selling stocks. So I kind of treat this more like a business. It's an income generator. So this is where I sell naked puts. So I do my analysis, both value and growth analysis, and there might be a particular stock that's trading at $10, and I'm like, well, I'm happy to buy that, but you know what? I'll sell a naked put at $9. So if the stock falls below $9, well, I'll buy it at $9, and in the meantime, I'll generate premium. Or when I own stocks in there, and so usually the stocks will fit in either a value or growth, usually larger, slower growing stocks, I'll sell out of the money covered calls, and that's primarily focused on generating income. There's a lot of stocks in there. So my strategy there with premiums, I generate about 20 to 25% a year in premiums, and with dividends, most of those stocks are paying around a 5% dividend as well. So we're looking at 25 to 30% a year in income on that part of my portfolio. And I'll discuss more in a second about what I do with those premiums. Then we got our small cap stocks, or what I like to call my speculative plays. So here is where I invest in the gold and silver miners, developers, explorers, commodity stocks, biotechs, and even emerging tech stocks. So, all this is a percentage of my portfolio. So that's how I break down my portfolio there. And as you guys know, I also own a lot of physical bullion, gold and silver. So then I have my options trading account where I buy and trade spreads like collars and bear call spreads, etc. And what I do, so going back to what I do with premiums. So what I do with premiums and dividends, I like to use it as, or call it playing with the house's money, is I'll take 70% of dividends and premiums and reinvest it back into my long-term investment. So my value and growth stocks, and even the small cap stocks as well. And then 30% I'll put into this account. And this is where I buy and trade spreads. So, leap options, long-term put options, as I said, collars, bear call spreads, all that sort of stuff. So, I'm playing with I look at it as playing with the house's money, but also it's only 30% of the house's money because I want to grow my portfolio through compounding. And, that's the thing, guys, is a lot of people, this is one reason why I don't give investment advice, is exactly what Warren Buffett said at the start of this video. I can't handle people's, it's not so much the investment strategy and all that, it's the psychology. I can't handle people's psychology. If you tell someone, well, here's a good stock, this is a stock that I like over the long term, and it doesn't go up in a month, then they're like, why isn't it going up? Or if it goes down 50%, I don't need that. I don't need that. So that's why I don't give advice. But I do education. So I like to teach people, teach them how to fish so that they can feed themselves, if that makes sense. So then I have real estate. And as you guys know, I've sold 4 of my 6 investment properties in the last just over 12 months now. So I still got 2 investment properties, no debt, and commercial. So this is only in medical healthcare. So like medical commercial buildings that have got doctor surgeries, dentists, physios, all that sort of stuff. And then, as you guys know, I do hold US dollars as a percentage of my portfolio, and currently that's around 5%, give or take, and then 2% in Aussie dollars, and that's outside of my emergency fund. And I do the basics when it comes to financial management. So, having an emergency fund, mine is about 4 months worth of expenses. Outside of that, I also have some physical cash, physical coins, both gold and silver, stored nearby that I've got access to if the what happens. And as you guys know, I use Austrian economics as my foundation. So from a macro and micro, just looking at valuations, subjective valuations, the business cycle, I use Austrian economics as my foundation, and I believe that's what gives me the edge over other investors. That Austrian economics then helps me to determine which sectors and even countries to invest in, which, once again, this is where I think it gives me the edge. And then at that point, once I've nailed it down to there, then I use a combo of, Buffett, Graham, Greenblatt, fundamental value analysis to look at individual companies within that sector, within that country that I've identified. And then I like to pick out the best ones from there. And just a heads up, the countries that I am bullish on over the longer term: India, Indonesia, Russia, Japan, and Tanzania. Some of those might surprise you, but for different reasons, I'm bullish on those countries. All right, so when investing, one thing I do tell people, or educate people, is revenue growth. Look at revenue growth. Is the top line revenue growing? Okay, so companies can increase their earnings, But if their revenue is going down year after year after year, that tells me, once again, this is the Austrian economics there, that tells me that the economy, which is human beings, human action, no longer values that product or service like they used to. So that's not a good sign. So keep an eye on revenue growth. So earnings yields and the next one, and look, you want at least the 5-year AAA corporate bond yield. Corporate bond yield is around 4% at the moment. So at least double that, so 8%. To be honest, historically, it's usually above 11%. So you want double-digit earnings yield. And earnings per share. So one thing that Peter Lynch talks about is earnings per share, that you want to look at the 5-year growth in earnings per share from continuing operations and making sure that it's less than 50%. And debt to equity ratio, less than 1, or if expressed as a percentage, less than 100%. I've spoken before about here in Australia during the GFC. I'm trying to think of that childcare centre. The guy owned the Brisbane Bullets basketball team. It's just escaped me now. They had a huge debt to equity ratio, and when the GFC hit, well, they got in trouble. Also, back in, I think it was around 2015-16, somewhere around there, Fortescue Metals as well, one of our largest iron ore miners, also had a big debt to equity ratio, and they got into some severe financial problems when the iron ore price dropped quite significantly and stayed low for quite some time. And yeah, they survived by the skin of their teeth. So being conservative, I look for a ratio of less than 1, or expressed as a percentage, as I said, 100%. Now, return on capital is a big one for me. I do look at return on capital. That tells me a lot about the business. And once again, you're looking for at least 10%, higher the better. So definitely double-digit return on capital. And very similar to return on equity, also double-digit, at least 10%, higher the better. Also, this tells me how good management are at investing each dollar of my investment. And dividend yield and growth. So dividend growth is probably more important than dividend yield. So Ben Graham says at least 2/3 of the 5-year AAA corporate bond yield. So yeah, it's about 4%. So you're looking at above 2.5% there at current levels. But a lot of people just look at dividend yield. You need to take into account the payout ratio. So I don't like companies that pay out all their earnings in dividends or have high payout ratios. I want companies to, especially companies that have got good return on capital and return on equity, I want them to reinvest the earnings into growing the business. But I do like to receive some of that earnings in dividends as well. But usually what I find is companies that can grow their earnings tend to grow their dividends over time. And so I much prefer getting pay rises each year than so much getting a high yield. So, for example, in Australia, Telstra has been one of our big blue chip stocks that a lot of retirees invest in because historically they've always had a high dividend yield. However, for about 20 years, they've paid the exact same dividend just about. So you haven't got a pay rise. So the same dividend each and every year, and there you go. So I prefer dividend growth over yield. So I just mentioned this payout ratio. So a rule of thumb is I won't invest in any company that's got a payout ratio above 80%. Because they're just not going to grow the business, grow their earnings, and therefore grow their dividend. So PE, or price to earnings, once again, Peter Lynch says, you want to find stocks within the industry that has, a lower or less than the median and less than the 5-year average PE. And I mentioned the PEG ratio earlier. So this is just the PE ratio divided by the annual earnings per share growth over a period of time. So I like to look over at least a 3-year period for mine, and I like it. Others don't, but I do.
So if you want to learn more about this style of investing and trading, using options, value investing, growth investing, using Austrian economics as a foundation, then I did this video back in July 2021, my top 10 economic investment and trading books. And what I'll do now, I'll put a link in the description below to the full video, but let's just cut to the last 5 minutes or so of the video where I summarize the books and share my top 10 economic investment and trading books.
All right, so my recommendations. Here we go. So here's a sample of some of my favorite investment and trading books. Now, I didn't talk about Poor Charlie's Almanac, but that's also one of my favorite books, The Skyscraper Curse. Trying to say that. How Austrian economists predicted every major economic crisis of the last century, the Solomon Portfolio, all these wonderful, wonderful books. But out of these books, which ones are my favorite for investing? So my top picks, obviously, as I said, I'm a Joel Greenblatt fan. So any one of his books I recommend. You can be a stock market genius. The best options book that I read is Get Rich with Options. And Lee goes through the statistics of options. So the amount of people that sell options that succeed. So I think it's something like 96%. I could be slightly wrong there. But people who buy options, 96% of people lose money. So the opposite's true. 96% of people that sell options make money. And there's this thing in the market called profit potential. When you talk about options, people love buying options because they look at the unlimited profit potential. But you got to ask yourself, what's your potential to profit? Okay, that's a different question. You can have unlimited profit potential, but if your potential to profit is low, then what's the point? So I much prefer taking smaller premiums every single month and just banking them. And then obviously the intelligent option investor. So this is applying value investing to the world of options. So these are my top 3 picks. So when it comes to precious metals, gold and silver, here's a range of books that I highly recommend that you read. Many of these you can download for free from the Mises Institute. And once again, I'll put a link in the description below. My top picks, however, would be The New Case for Gold. It's brilliantly written, very easy. Jim Rickards puts his arguments for gold very strongly in this book. And obviously, I just recommend any person even thinking about investing in gold and silver should get it. Joe Salerno's Money, Sound and Unsound, once again, just really explains money. What is sound money and what is unsound money. And many of you already know that, but the way he puts it together is just superb. And then obviously got to throw Murray Rothbard in there, The Case for 100% Gold Dollar. I really, really like that. But to be honest, any of those books, David Morgan's book on silver is a great book about the history of silver and where silver has been used as money more times than gold. So, any of them will work. And here's a sample of my top economic books. An essay on economic theory by Richard Cantillon, America's Great Depression by Murray Rothbard, What Has the Government Done to Our Money? The Case Against the Fed from Rothbard, Keynes the Man by Rothbard. Look, I mentioned earlier about Man, Economy and State being my favorite economic book, and Human Action as well, and it being quite difficult to read and understand. Bob Murphy, Professor Bob Murphy, has done a study guide on both Man Economy and State and Human Action. So definitely recommend those study guides from Bob Murphy. Economics in One Lesson, no brainer. The Panic of 1819. Now, also, I mentioned The Mystery of Banking by Rothbard, but also another one that doesn't get a lot of credit is Ludwig von Mises' The Theory of Money and Credit. Once again, brilliant book. So what are my top books? What are my top favorites? So we've had 3 from the other 2 categories, so that's 6. So I've got 4 here, which will make up my top 10. So my top picks is an essay on economic theory by Richard Cantillon. Now, I just think Richard Cantillon deserves the credit that is due to him, because if people say Adam Smith is the founder of modern economics or capitalism or whatever, it's wrong. You got to give Richard Cantillon the credit, and at least Murray Rothbard does give him a lot of credit. So that's one that I highly recommend people read. You've probably heard of the Cantillon effect, or people pronounce it the Cantillon effect. That's from Richard Cantillon. So definitely recommend it. Obviously, Economics in One Lesson is a go-to book, and you can get free copies at the moment from the Mises Institute. Free hard copies, so not an e-copy. Obviously, Man Economy and State, and if you find that difficult, Bob Murphy's study guide to Man Economy and State. But Man Economy and State, Murray Rothbard's my top economist. Ludwig von Mises is my second. I know that's heresy, but I'm sorry. I just love Murray Rothbard. The guy knows how to debate. He knows how to write. His arguments are very persuasive. I'm just a Rothbard fan. And The Theory of Money and Credit by Ludwig von Mises. I was tossing up between this one and his socialism book, because that also impacted a lot of people. That changed people. That really stopped that Marxism, that socialism movement in its tracks, really. And unfortunately, we need a Ludwig von Mises today, because it seems that young people, and there's a move towards the left, move towards embracing socialism and Marxism and communism once again. Well, there you go, guys. I hope you enjoyed this video. I hope you take away Buffett's investing advice. I hope you enjoyed what I had to share about my own portfolio, how I allocate capital, and my philosophy around investing. I hope you found that valuable. And definitely check out some of those books that I recommended as well. Guys, if you like this video, really do appreciate it if you hit that like button. Love to see your thoughts and comments below. And let me know if you want more videos like this, if you want me to talk more, go into more detail on things like return on capital, earnings yield, return on equity, stuff like that. Let me know in the comments below. Happy to do. I love teaching. I love giving education. I don't like giving advice. I like giving education. So let me know in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.